Hello there. Today we're going to solve an IGCSE accounting paper 1 variant 1 from the May-June 2022 session. You have 1 hour 15 minutes to solve 35 MCQs worth 1 mark each. All right, let's begin. You have enough time, more than enough time to complete that, complete the 35 MCQs in 1 hour 15 minutes. Which task would be carried out by a bookkeeper? Question number 1. Comparison of financial statements between years? No. If you know the definition, that's not right. Preparation of financial statements, provision for information for decision making, all these things are done by an accountant, right? Not a bookkeeper. A bookkeeper records financial transaction by definition. If you know the definition of bookkeeper, you know that that's the answer. What is the accounting equation? Accounting equation is assets equal capital plus liabilities, and you may have different variations of that. Asset equals capital minus liabilities, definitely wrong. Asset equals, definitely wrong. Asset minus liabilities equals capital. With basic algebra, we know that if we remove L on both the sides, we can say assets minus liabilities equals capital, right? That's basic algebra. We've learned it in maths that we just move the L on the other side basically. So this one seems right. Option C. Option D is also certainly wrong. Let's move on. Question C. Sarah sold goods on credit to Zafar. Always clarify the relationship. Who's the seller? Sarah is the seller. Zafar is the purchaser. How was this recorded in Sarah's ledger? The one who's selling, Sarah. So of course it's the sales. So sales will be credited for Sarah. Let's see. Credit sales account. That's for sure. Yeah. And debit Zafar as a receivable. So this one's simpler than I thought, right? From Sarah's perspective, she's the seller. It means she's making sales. Sales account is never debited when you make a sale. It is always credited. So credit sales. See how they trick you with the debit, the word debit here. So, oh wait a minute. I think I just fell for the trick. Never mind. That's not the right answer. We know that sales. Okay, so don't get confused. This is not debit credit like that. First of all, look at the heading there. It's the general ledger. Remember, your sales account does not go under sales ledger. Your sales account goes under general ledger, which is here. And so you will credit your sales account in the general ledger, and you would debit your Zafar account, the customer account, under the sales ledger. I kind of ignored this heading at first. So A is the right answer. Let's move on. Don't fall for it, guys. That's why you need to practice MCQs. Number 4. Omar sent a credit note to Miriam for goods returned. How would Miriam record this? Understand the relationship again. Omar is the one sending the credit note, must be the seller. How do I know that? Only seller will send credit notes, right? And that's the customer. Only the seller can issue credit notes. And so now we know Omar is the seller. For Miriam, since she's the customer, it's got to be purchases, right? Omar is the one selling, Miriam is the one purchasing. When goods are returned for Miriam, that is purchases returns. So this one's gone. It's not sales returns, purchases returns, and you should know by nature purchases returns are credited, and so Omar is going to be debited. Since Omar is a supplier, and when there is return, the supplier account is debited and purchase returns is credited. Question 5. The discount column, yeah, done with 4. Number 5. The discount column on the debit side of a trader's cash book totaled 1300, and the discount column on the credit side totaled 700. Do you know which one is which? On the debit side, you receive money in a cash book. You receive money on the debit side, and so you will allow the discount. That's where the discount allowed goes, and that's where the discount received goes. Because here you're paying money and you're going to receive discount. Here you're receiving money, you're going to allow some discount while receiving it. So this tells us 1300 is discount allowed and 700 is discount received. Let's see. How much discount did the trader receive? That is 700. You must understand which one goes where. This is basic knowledge. Anybody who knows what a cash book looks like should know that it's going to be B. Let's move on to question number 6. CAIE bought office equipment from Mina and paid immediately by bank transfer. How should CAIE record this in accounting records? So Kai bought some office equipment from Mina. We're looking at Kai's perspective. Kai is the one paying, and so bank must be credit. We know that. Now, it doesn't make sense to debit Mina. If you debit Mina, well, Mina is just the person's name, and it would indicate that it's a receivable. You only debit with the business name when something is your receivable. It does not make any sense, right? Office equipment is going up, bank is going down, and that's all. Why? There's no purpose to have Mina's account in our books. There should be a purpose when you record someone's name or someone's business name in your book. Either they owe you the money or you owe them money. It's either receivable or payable. There's no such thing with Mina. So this does not make sense, all right? Question 7. Jabari maintains a petty cash book using imprest system. Hope you know what is imprest system. The imprest is restored at the end of each month. That is actually what imprest system is. That's part of the definition. Which amount restores the imprest at the end of a month? The amount left in petty cash less the total of vouchers received. The amount left in petty cash plus the total of vouchers received. No, look, if something's left in petty cash, we don't need to refill that. Can you imagine? So we need to refill what was used up. You get it? And by the way, vouchers are proof of money going out of petty cash. So the point is, the first part tells us these two options are wrong. Okay? The imprest amount less the total of vouchers received. Now that represents the remaining money. Remaining amount. Why would you refill the remaining amount? It's already, like, for example, your imprest amount is 100 and the vouchers received was worth 70. That means 70 was spent. The remaining is 30. Why would we refill 30 more? We don't need to refill 30 extra. It will make it 60. It does not make sense. The totals of vouchers received, that makes the most sense. What that means is the amount of money that was spent will be refilled. In this case, 70 was spent from the 100. That's the amount, that's the number of vouchers received. We're going to refill that one. So D is the right answer because whatever was spent will be refilled. That's how the imprest system works. Question number 8. Which statement about a trial balance is correct? It assists in locating arithmetical errors in bookkeeping records. That makes sense. That should be correct. But let's see. Let's read the other options. It is proof that the entries in ledger accounts are free from error. No, it may still have an error. Trial balance does not identify every single error. So we cannot say that. It reveals all bookkeeping errors. No, it doesn't. It's the same thing. It shows ledger account errors only. It shows ledger account errors only, but we do have the cash book, which is kind of a ledger account. Let's see how that would be wrong. Although option A is certainly correct, but let's just see how D is. Well, we can't say, I mean, ledger account errors only. So what else do they have? Oh, okay. So we may have made a mistake in journals, perhaps. You get it? Imagine you made a mistake in journal. That will also be revealed by trial balance, right? If you made a mistake in one of the journals or books of prime entries. So it's not just ledger account mistakes that are going to be caught. Even journal mistakes may be caught with a trial balance, right? For instance, one of the entries in the journal is incorrect while the total is correct. Some sort of an error made in the journals may also be identified with the trial balance, right? It's a possibility. What is an example of a compensating error? Compensating error is two unrelated errors. One is overcost, one is undercost, and somehow they cancel out each other, right? So let's see. Just by looking at the keywords, to me, D seems right. Just by looking at the keywords, because that's what you will always see in compensating errors, these words. If you have practiced a few papers, you know what I'm talking about. But let's see. A payment for office equipment repairs was debited to office equipment account. Office equipment repairs, office equipment. One is an asset, one is an expense. When you mix it up, this is called error of principle, right? Error of principle. I'm not going to write that whole thing, but you hear me, right? Error of principle. When you mix up the categories. A purchase of good from C. Jones was credited to account of C. Johns. Okay. This is called this is called error of commission. That's error of commission when you mix up the accounts. The sale of goods $65 to A Aziz was entered in the books as 56. And we can say that is a transposition error, right? Or we can even say that's error of original entry, right? That's fine. The wages account was undercost by $100 and the rent account was overcost by $100. Do they have any connection? They were not connected. Others were connected. So there was a confusion in others. But in this one, it was totally by let's say coincidence. You get it? So your expenses understated, your other expenses overstated, and they cancel each other out. One expense is missing 100, another expense is added up by 100 extra, and so it cancels the effect. That's the point. Let's move on. Oh, let me circle 9 downstairs D. Question number 10. After the preparation of Abdul's draft financial statements, 2 errors were discovered. The purchase of machine by bank transfer 5,000 was omitted from the accounts, never appeared. The purchase of motor vehicle 15,000 was entered in the motor vehicle repairs account. What effect will correcting these errors have on non-current assets and the working capital? Working capital is basically your current assets minus current liabilities. Let's see how that's going to work. The purchase of machine by bank transfer was omitted, so we're going to increase our non-current assets by 5,000 firstly. Increase it by 5,000. What else is happening? The purchase of motor vehicle 15,000 was entered in motor vehicle repair account. Okay, oh, and by the way, for the first one, if you notice, the purchase of machine by bank transfer, we omitted that, and that means we did not record the bank transfer as well, and so our current assets will go down by 5,000, right? Our current assets will go down by 5,000 because this was previously never recorded, but now we realize, and so we have to remove 5,000 from our bank, which goes into current assets, and we have to increase our non-current assets by 5,000, which was never recorded before. For the second one, the purchase of motor vehicle 15,000 was entered in motor vehicle repairs account. So instead of putting something as an asset, we put it as an expense. It does not have any effect on working capital, but it does have an effect on non-current assets. We essentially ignored this 15,000 worth of asset that we bought. And so we're going to add that to non-current assets. In total, by correcting the errors, our non-current assets will go up by 20,000, and this will go down by 5,000. I was almost going to go for no effect, but then I realized, of course, we have this bank transfer as well. You need to be really careful, guys. Okay, always look at the full, look at it with full focus. Let's keep moving. Number 11. Raj had a debit balance of 10,800 in the bank column of his cash book. So he has 10,800 in the bank. He discovered that purchases 890 paid by check had been recorded as 980. So his bank account was credited by an extra amount, right? It was never that much. It was less than that. So let's see how much is understated. 980 minus 890, that's $90. Currently, he's supposed to have 90 more. He's supposed to have that. So he's missing 90, right? Right now, missing 90, or essentially understated by 90, you can imagine. The following appeared in the bank statement but had not been entered in the cash book. So a few more updates need to take place. So bank charges, we have to subtract that. Interest received, we have to add that. What was the debit balance after adjusting for these? All right, so we start with 10,800. This 90 is missing. Let's add it back. It was supposed to be there, but since we over subtracted, we're going to add this back, the difference. And then the bank charges are subtracted, of course, because that's the money paid. And interest received, it's coming in, so we add 120. Let's see. 10,800 plus 90 minus 76 plus 120. That's 10,934. 10,934. Yes, we have the option. Let's move on. Why is a sales ledger control account usually prepared by a different member of staff than the person who maintains the sales ledger? To avoid any fraud, right? That's one of the advantages of sales ledger control accounts. So somebody who's maintaining the ledgers, the sales ledger, If that person is playing with the sales ledger, involved in a fraud or something, trying to manipulate those books, somebody else is going to prepare sales ledger control account from the books of prime entries, and if there are any differences, that will be caught, right? But if the same person does it, the same person is going to, well, make the same changes, or make the same manipulations with the control account as they did with the sales ledger, and so they can get away from a fraud they might be involved in. And so to deter fraud, it was a very straightforward one. It's one of the advantages, one of the reasons we make control account, that it sort of separates the responsibility. Can move on. Number 13. Tamal provided the following information for March, his first month of trading. Credit purchase returned, total payments to credit suppliers. So this is leading towards making a control account. And actually, I notice, yes, that's what it is about. If you have practiced enough, you'll be able to notice what's going on. What's going to be the question? During the month, Tamal overpaid a supplier by 94. He did not make any further purchases from this supplier in March. You should know that normally you owe your suppliers. You have to pay your suppliers. Sometimes, however, when you overpay your suppliers, in this case, the supplier is an asset. The supplier is a receivable. We're going to receive this money from supplier later on. And so it's one of these, C or D. For the rest, we just need to take the balance. Okay, so during the year, there were credit purchases of 9,100. That's a liability. 322 were returned, so that reduces the liability. And 5358 was paid, so that also reduces the liability. So what was Tamal liable at the end? Let's see. 9,100 minus 322 minus 5358. That's 3420. But wait, we are missing out on the credit balance as well, right? There was an overpayment. So out of this amount paid, 94 he was not supposed to pay, right? He was not supposed to pay the 94. So we have to add that 94 back. And so we'll get 3514. 3514. That should be the answer. Personally, I don't like that method. What you can do instead is make a T account. That is definitely much better than making these calculations. So you got to know what the format looks like. Do we have any opening balances? None. It's the first month of trading. First thing that happened in the purchase ledger control account here is the credit purchases. Purchase ledger control account will be credited by that. If you know the format, you know it's credited, credit purchases, because it increases the liability. And when there are purchase returns, you debit the purchase ledger control account. And then the payments also debit the purchase ledger control account. And then finally, they have given us some debit balance. Normally, you have a credit balance in PLCA, but in this case, we have a debit balance, a receivable. That's balance brought down. And so balance CD will also appear over here. Now, we will balance this and you will get 3514 as a balance carried down. This is your regular balance you're supposed to get. This is the irregular one, 94. This is unusual, right? It happened because you overpaid your supplier by mistake. So we can keep moving. Number 14. The following payments were made by John when he purchased a machine. Okay. How much should have been debited to machinery account? Essentially, this one's about capital expenditure and revenue expenditure. Let's see. So purchase of machine itself is part of capital expenditure. That will be capitalized going into machinery account. Delivery charges, yes. Cost of delivery is also included. Insurance is a maintenance sort of a cost. It's a revenue expenditure. Installation, yes, that's part of the definition. What is capital expenditure? It is the cost of purchase of a non-current asset, and the delivery cost, and the cost of installation of that asset. Okay. Prepaid maintenance charge, again, that is maintenance. Although it's prepaid, but it's maintenance. It's gonna keep happening. It's a revenue expenditure. And so in total, if you add 10,000 plus 1,200, plus 900, it gives us 12,100. That should be the right answer. All right. Done with question number 14. Let's move on. Number 50. On 1st January, Zach entered the cost of repairing equipment 420 in the equipment account, of course, as an asset, but that's a mistake. Zach entered the cost of repairing equipment in the equipment account. That's a mistake. Error of principle. Was never supposed to be in the equipment account. That is an expense. So our equipment is overstated. We know that for sure. On 31st December, depreciation 20% per annum using straight line method was charged on the balance of equipment account. 20% of this was also taken, which was never supposed to be taken. What was the overall effect on the book value of equipment on 31st December? Overall effect on the book value. Now, 420 was the effect. Yes, true. However, we deducted 20%. And so now the remaining effect is, this is overstated. 420 is overstated, but then we took away 20% of that. So 20% of that is 420 times 20%, 84. 84 was essentially taken away. So 420 minus 84, 336. This much effect still remains. It is still overstated by 336 because we already removed 20%. You got the point, hopefully. Number 15, the answer is B. Let's move on. Number 16, Atif depreciates his motor vehicle at a rate of 20% per annum using reducing balance method. On 1st May 2021, Atif owned motor vehicles which cost 35,000. At that date, the motor vehicles had been depreciated by 12,600. That's on 1st May. What was Atif's balance on provision for depreciation account on 1st May 2022? That's the opening of the next year. Well, this is the balance on the depreciation account right now. Now we'll calculate the new depreciation, which is going to be 35,000 times, minus 12,600. Whatever we get, the net book value times, what is the percentage? 20%. Let's see. 35,000 minus 12,600, 22,400 times 20% is 4480. 4480. That's depreciation for the year ended April. For the year ended 30th April 2022, right? And now on 1st May, the first day of the next year, the balance is going to be 4480, the new depreciation, 12,600, the old depreciation. The total depreciation so far is 12,600 plus 4480, 17080, 17080. Let's go. Let's move. Number 17. The financial year of Jung ends on 31st March. On 1st April 2021, that's the opening, he purchased a machine for 4,000. He estimates that it would be useful for 3 years and residual value will be 100. Jung uses straight line method of depreciation. The machine was sold on 1st April 2022, just 1 year later, for 1,500. What was lost on disposal? For now, ignore this. First, let's calculate what's the net book value. Step number 1, let's calculate what's the depreciation charge per year. So it's going to be 4,000 minus the residual value divided by 3. Essentially 3,900 divided by 3. Let's see. 3,900 divided by 3. 1,300. That is depreciation per annum. We only used it for 1 year. So what's the value going to be after 1 year? 4,000 was the original value, cost, minus 1,300 the depreciation. 4,000 minus 1,300. 2,700 is the carrying value, the net book value at the end of year 1. After 1 year, this is the value that we think. However, we only sold it for 1,500. And so the remaining amount, the gap between that, 2,700 minus 1,500, the 1,200, is loss on disposal. Because we thought it's worth 2,700 after a year, after calculating the depreciation. In reality, we only got 1,500 for that. And the loss on disposal was 1,200. Let's keep moving. Question number 18. On 1st April 2021, commission receivable 210 was outstanding. Commission received during the year was 4850. And which journal entry should have been made at the end of... All right. The point is, what belongs to the current year? So you see, in the beginning, 210 was outstanding, unpaid. When we got the payment, out of the payment, 210 must be belonging to the last year. Out of the 4850 we received, 210 does not belong. It belongs to the last year. So when we subtract 4850 minus 210, 2640, 2640. Oh, wait, we don't have an option. Oh, no. What am I doing? It's not 2640, it's 4640. 4640, there we go. And it's one of these options, A or C. Now, you should know, you should have that knowledge. Your income statement is credited by the income. Your income statement is credited by the income. When you make an income statement is credited. For this, you need to know the horizontal format of income statement. There we go. A is the answer. Let's move. Number 19. Which statement about a debts recovered account is correct? Which statement about a debts recovered account is correct? It's an income account. We know that. But let's see. The account is used when an amount previously written off is received from a customer. This seems correct to me. Nothing wrong with that. Pretty okay. The account is used when doubtful debts are recovered. Doubtful debts are never even gone. It's just estimates. We don't lose doubtful debts. Well, ultimately we do, but then we count them as irrecoverable debts. Doubtful debts are not recovered. They're doubtful. They don't even incur physically, like actually. You know what I mean? They're just estimates. The balance of the account is debited to the income statement at the end of the year. Are they debited? I just told you a few seconds ago. The income account, which this is, it's an income account, is never debited, it's credited to the income statement. Wrong. The balance of account is shown in the SOFP. The balance, wrong. Is it? Wait. Well, it's an income. That's recovered account. The balance of account is shown in this SOFP. Well, why would it be shown in the SOFP? There's no purpose, right? That's recovered. It's just an income and it is written off in the income statement. That's it. It's just put into income statement. That's all. There is no purpose of having a balance on this account, which will be then, it's not an asset or a liability. SOFP contains assets, liabilities, and capital. So it does not fit in one of those categories. Remove it. That is the perfect, I would say, explanation to this. Let's do number 20. Nula's financial year ends on 31st December. She maintains a provision for doubtful debts of 5% of trade receivables. On 1st January 2021, the provision amounted to 800. That's the opening provision. And on 31st December, the trade receivables are these, and 600 was regarded as irrecoverable. So firstly, you get rid of that. 13,400 is the receivable, but not anymore. 600 won't be received, and so we remove that. The answer here is 12,800. That is the real trade receivables, and on that we apply 5%. We get 12,800 times 0.5, 0.05. That is 640. Now 640, is that it? No, that's not it. Oh, well, we can say how much was the provision for doubtful debts on 1st January. That's the balance. But if they ask you to say what will be transferred to the income statement, that's going to be the difference. It's an income, actually. It went down from 800 to 640. 160 is regarded as an income in the income statement. But here, the question is to give them a balance, and that would be 640. Okay. I will pause the recording here, and I just need to answer my call, and then I'll continue recording this lecture. All right, let's continue. Question 21. When preparing his financial statements, the trader valued his inventory at cost. Okay. He then found that 10 units of inventory costing $12 per unit were damaged. If he spent $2 per unit on repairs, he could sell them for $9. Do you remember the inventory valuation rule? The inventory valuation rule is lower of cost and NRV. So if the cost is 12 and 10 of those have this issue where the NRV is the net realizable value is the selling price minus the cost of repairs, $7. That's the way we find the NRV, the method. Now you see 10 of these were overvalued because we have to take the lower one. In this case, 7 is lower than 12. 10 of these were overvalued by $5 because 12 minus 7 is 5. Is it? Yeah, it is. So 10 times 5, this was overvalued. Now let's see how that's going to affect. What was the effect on the income statement of the incorrect inventory valuation? Well, of course, if gross profit is overstated by 50, it's going to be overstated. The reason is your closing inventory is overvalued. When closing inventory is overvalued, it is directly connected with profit. If closing inventory goes up, the gross profit goes up. The reason is, how do you find cost of sales? Opening inventory plus purchases minus closing inventory. So if you notice, closing inventory reduces cost. Hope you got that. Closing inventory reduces cost and in turn increases profit. This sort of a relationship between closing inventory and profit, you should know about that. If closing inventory is high, the profit is going to be high arithmetically. That's how mathematics of the income statement works. Let's move on. 22. At the end of his financial year, Marek was owed $200 for interest on a loan he had made to an employee. So that's a receivable for Marek. Okay. He recorded this in his financial statements. How did the interest on loan affect Marek's profit for the year, and where was it recorded in his statement of financial position? Of course, the profit for the year increased because it will be other income, not an expense, of course, an income, because he's the one who's going to receive the money, and it's a current asset because the employee has not yet paid Marek. Let's move on. What is the purpose of preparing a partnership appropriation account? It is to distribute. It is to allocate the profit to each partner. Let's see how. Let's see the options available to us. To calculate the interest to be charged on drawings made by each partner. That's not the reason we prepare appropriation, although it's part of it. To calculate the interest to be paid on capital invested by each partner, again, it's part of it, but it's not the reason we make the appropriation account. To show the amount of salary to which, again, it is part of it, but that's not the purpose. To show the division of profit, there we go. That's the right answer. That's what I mentioned in the beginning. You will be tempted to choose each of these because they are part of the appropriation account. But that is not the purpose. If you think this is correct, then you might as well say this is correct, or even this is correct. It's the odd one out, right? All of them seem correct, but the common thing is they are all just part of appropriation account. They're not the purpose of appropriation account. Hope you all got that. To show the division of profit or loss for the year between the partners, there we go. That's what I told you in the beginning when we read the question. Question number 24. Raj and Seema are in partnership, sharing profits and losses 2:1. Raj 2, Seema 1. Raj withdrew $5,000 during the year and was charged interest at 3%. Seema did not make any withdrawals during the year. The profit for the year was $30,000. All right. So we'll make a mini sort of a appropriation account, right? 30,000 is the profit, and Raj essentially was charged with 3%, and you should know that the interest on drawings is added back. 3% of 5,000 is 150. Okay, so this is the distributable profit now, and of course Raj gets 2/3 of that. $20,100. That's what Raj gets from the profit share. Raj gets that from the profit share. But remember, Raj also, that should be enough because they're asking for what was credited to Raj's account. Although this will be debited to Raj's account and 150 will be debited to Raj's account. But the question is about what will be credited to Raj's account. Let's move on. Sometimes there are multiple things credited to the partner's account, and you have to take that into account. Number 25. A limited company raised funds from an issue of debentures. It's a kind of a long-term loan. Which statement is correct? The debenture are part of equity of the company? No, equity is the owners. They're not the owners. The debenture holders cannot vote. That is true. They cannot vote because they are liabilities. Very simply, they are true, and we can keep moving on. A limited company provided the following information. What was the profit for the year? Total equity, we have the opening equity, ordinary share dividend paid 30th June, so that's, I guess, interim dividend. Yeah, that's during the year. Transfer to general reserve, total equity at the end. And what must be the profit for the year? Okay, interesting. Let's see. Now, there were some changes in equity, right? Which one of them must be caused by the profit for the year? Now, essentially, look, we have some equity at the opening. 500,000. You know what? Let's ignore the thousands. Let's ignore the zeros. 500,000. Let's imagine that's in thousands. Ordinary share dividend paid. That takes away from equity. Transfer to general reserve. That does nothing to equity. And then our profit, which will increase the equity. We don't know what that amount is. At the end, we get 558. We are left with 558. Again, I'll repeat that. In the opening, we have 500. This was paid out. Then some profit came in. We don't know the amount. And at the end, we're left with this. So we sort of created an equation for this. There will be other ways, but this is the way I like to do it. 500 minus 25, that's 475, plus x equals 558. X equals 558 minus 475. Let's see. 558 minus 475. That's 83,000. Question 27. Which group contains only items included in prime cost? Direct, it's all the direct ones. Direct expenses, depreciation, no. So that's wrong. Direct wages, supervisor, that's indirect, no. Factory overheads, right away, no. Raw material, direct material. Royalties, direct expenses. Direct labor, yes. D is the right answer. Let's move on. Number 28. The work in progress of ZT manufacturers on 1st January was valued at 6,200. At the end of the year, it was valued at 5,400. What was the effect on the cost of production? The cost of production, we add opening and we subtract closing. You know that, right? Work in progress. So overall, if you notice, the opening which is added is more than the closing which is subtracted. So overall effect was to add. Are you getting the point? Hope you understand. So we added a total of 6,200 and we subtracted 5,400. The net effect, the overall effect of that is 6,200 minus 5,400. That's 800 added in all, like overall increase of 800. We can keep moving with that. Question number 29. A trader does not keep full accounting records but was able to provide the following information. We have opening capital, closing capital, drawings. I like this one because there's one specific formula that I've been using for so long with all the students. I've mentioned this in the past as well. I just call it magic formula. It is not called as such in any of the books, but I just call it because I don't know why. I just call it. It's a magic formula for your incomplete records chapter. Your whole incomplete records chapter is based on this equation, we can say, where we start with opening capital plus profit or minus loss minus drawings plus capital introduced equals, and minus drawings if I mentioned that, equals closing capital. So let's see. During the year, this was withdrawn from the owner's private bank account to purchase a motor vehicle to be used by business. Don't be tempted. Don't just simply think that this is drawing. This is actually capital introduced. Capital introduced. The owner introduced this 9,500 worth of motor vehicle into the business. Now opening capital, that's how the magic formula goes. Plus capital introduced minus drawings and plus the profit, which we don't know yet. We can just say X. We don't know the profit because what we know is it's going to increase the capital. And we've covered everything else, yes. And then finally, we have the closing capital of 37,000. With some basic algebra, you're going to just net that. 26,000 plus 9,500 minus 6,500. That is 29,000 plus X equals 37,000. And so X equals 37,000 minus 29. 37 minus 29. That is 8,000. It's a very common formula. Keep that in mind. I think I said it a few seconds ago. You can watch that again. Question number 30. A business provided the following information. What were the purchases for the year? Easy. How do you calculate rate of inventory turnover? You do cost of sales over average inventory. That gives you the rate of inventory turnover, right? The rate of inventory turnover. Now let's see what we can find. So cost of sales we don't know. Average inventory, let's average these two. The average of these two is going to be, well, 6,800 plus 6,000 divided by 2 6,400. That's the average. And so average inventory equals 5. So X equals 5 times 6,400. 32,000. 32,000. That's cost of sales. If we know cost of sales, we know that opening inventory plus purchases minus closing inventory is cost of sales. Opening inventory plus purchases minus closing inventory equals cost of sales of 32,000. With some basic algebra, we can just move the 6,000, add it over there. 6,800 subtracted from the other side. So 32,000 plus 6,000 minus 6,800 gives us 31,200. 31,200. It's a common type of question. That's why I suddenly realized what it is. It talks about rate of inventory turnover. Cost of sales is part of it. It talks about opening inventory, closing inventory, purchases. Cost of sales is part of it. You have a couple of indications that lead you to finding cost of sales. Let's move on. Number 31. Jerry started his business on 1st January 2022 with no opening inventory. Okay. On 19th April, a fire destroyed all his inventory. Jerry provided the following information for the period 1st January 2022 to 19th April. So part of the year. Okay. What was the value of inventory destroyed? Let's see. We have the revenue. We have the purchases given. Do we have anything else? No, that's it. No opening inventory. Well, gross margin. So if we use the margin markup concept, the revenue is 30,200. The cost of sales at the given point, we don't know, cost of sales. And the gross profit. Okay. So if we look at it in terms of percentages, gross margin means gross profit as a percentage of the sales. And if that is the case, it's 100 here. Gross profit is 25% of that. And so that makes the cost of sales 75. You need to understand this concept first of margin markup. That will help us find cost of sales. 30,200 divided by 100 multiplied by 75, that is 22,650. This tells me that the cost of sale at this point is 22,650. If that's the cost of sales, that's the purchases. Let's see. There's no opening inventory, right? So opening inventory plus purchases minus closing inventory gives us cost of sales of 22,650. And so 25,600 minus 22,650 is 2,950. 2,950. If everything went well, it indicates this is going to be our closing inventory. If everything was fine, 2,950. But in this case, all his inventory was destroyed. It means this was destroyed, which could have been the closing inventory. Hope you all got that. I know it's a bit confusing, but you need to know this margin markup thing. With that, we got the closing inventory. And once we got to know the closing inventory, but it says, everything was destroyed. Well, 2,950 was destroyed. Let's keep moving. Number 32. A trader provided the following information. What was the return on capital employed? How do you calculate return on capital employed? It's PBIT, profit before interest and tax, over capital employed times 100. So the profit before interest and tax, well, it's 24,000. Over, what is the capital employed? Capital employed can be calculated in multiple ways. One of the ways is capital plus non-current liabilities. So 120,000 plus 30,000 times 100. So essentially that is 24 over 120, 150 times 100 gives us 16. 16%. That's the return on capital employed. Let's keep moving. Number 33. These last few questions are often very, very, you can complete them quickly. Which actions could a clothing retailer take to improve his rate of inventory turnover? How to improve his rate of inventory turnover? To move the inventory faster. That's what inventory turnover is. We need to move the inventory faster. Increase the selling price. Do you think the inventory is going to be selling faster if we do that? Not really. Offer discounts on last year's designs. Yeah, that's going to move the inventory faster. Pay clothing suppliers as quickly as possible. I believe that's not connected. It might be in some way, but it apparently seems like it's not connected. Pay clothing suppliers as quickly as possible. No, that doesn't affect the rate of inventory turn over, right? The way we calculate is cost of sales over, average inventory. So this payment has nothing to do with it. It's about selling our inventory, as fast as we can. It's going to be 2. Basically trying to reduce this, right? Average inventory keeping as, if we reduce our inventory held, it's going to increase the inventory turnover. Let's keep moving. Number 34. A trader is considering selling goods on credit to a new customer. What could be calculated from customers' financial statements to indicate that the time normally taken to pay for goods purchased on credit? Awesome. It's very easy. Trade payables turnover. How long that person takes to pay his or her suppliers regularly. So this is very straightforward. That's what trade payables turnover does. That's the whole purpose of it. Which accounting policy requires that the information in financial statements is free from significant errors? And that is reliability. If it is free from errors, people will rely on it, right? Reliability means you have this sort of a trust in the financial statements that they're free from errors and bias, opinions, subjectivity. That's it for this paper. Hope you all understood something out of it, and have an amazing day. Subscribe to the channel for more such videos. Goodbye.